So what's the real deal with the U.S. housing market in 2024? Because from the looks of it, everything can crumble down soon. First-time buyers are basically playing with monopoly money. Crazy high prices and laughable down payments squeeze them out. It's the eternal renter's curse. Then you've got the mortgage rates playing hide and seek. If inflation gets cheeky, expect those rates to soar, sending home sales into a tailspin. But wait, there's more. Baby boomers are downsizing big time, flooding the market with homes. It's a potential price drop bombshell, but experts can't agree. Some say prices will plummet, others expect them to rise. It's like they're all reading different crystal balls. And the millennials? They're eager to buy, but drowning in debt. It's a classic case of real estate FOMO meets harsh reality. The latest scoop from Realtor.com is pretty telling. Home prices are taking a bit of a nosedive. At the end of 2023, the average Joe's dream home in the U.S. is now tagged at $410,000. That's a drop of nearly 9% from the dizzying heights of June 2022, but hold your horses. This isn't exactly a fire sale. Reflect on the pre-pandemic era when the median list price was a more modest $300,000. Fast forward to today, and we're still staring at a hefty $410,000. It's like the price has got a gym membership and bulked up big time. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. And let's talk about mortgages. Not everyone's favorite topic, but hey, it matters. Mortgage News Daily tells us that the 30-year fixed mortgage rate is lounging around 6.7%. Sure, it's coming down from the terrifying 8% peak last October, but it's still way above the comfy levels we saw pre-pandemic. The bottom line? Most wannabe homeowners are still in big trouble when it comes to affording these homes. This affordability circus is causing a major slump in buyer demand. Picture 2024 starting off like a party where half the guests didn't show up. The Redfin Homebuyer Demand Index down by 9% from last year and a whopping 40% from its 2022 glory days. It's like buyers are playing hard to get, and who can blame them? If we're ever going to see a comeback from these buyers, we need both prices and mortgage rates to take a chill pill and drop further, especially in those markets that are currently strutting around like they own the place. Take a peek at the RevVenture app, and you'll see these overvalued housing markets painted in glaring red. Atlanta, for instance, is strutting around at 33% overvalued. Talk about living in a bubble. And then there's Miami, also flexing at 33% overvalued. Deja vu, anyone? These numbers are a mirror image of the pre-2006 housing crash frenzy. Now, here's a fun fact. Post-last downturn, Miami's prices were in the bargain bin, a golden era for buyers. So, for the savvy ones among you who keep an eye on overvaluation, inventory, and those seller price cuts, you might just hit the jackpot and find that perfect moment to swoop in and grab a bargain. Let's get real here. America's housing market is turning into a bit of a circus. Picture this. Sellers are throwing in the towel left and right, slashing prices like they're on some wild clearance sale. Take this one townhouse, for instance. A decent-sized place with 3 bedrooms and 4 bathrooms, sprawled over 2,100 square feet. It was hanging in the market for $498,000, but guess what? The seller just hacked off $52,000 from the price, a solid 9% drop. It's like watching a desperate game show contestant. If you snoop around Zillow's value history, you'll notice the current list price is harking back to the good old days of early to mid 2021. But wait, here's the kicker. Mortgage rates today are sky high compared to 3 years ago. So if you fancy buying that house on a mortgage, prepare to cough up around $3,400 a month. That's over 40 grand a year, folks. In today's economy, for most of us mere mortals, that's a wallet buster. It seems like the housing market's turning into a real snooze fest for home buyers, especially for those poor souls hunting for a home in the past 2 to 3 years. They're getting fed up. Prices might have dipped a bit, but they're still stratospheric, and for many, just doesn't feel like a deal. So, a lot of potential buyers are just checking out, losing interest, and abandoning the market. No wonder mortgage applications are scraping the bottom of the barrel, and Google searches for homes are plummeting. Speaking of Google, did you know about this nifty tool called Google Trends? It's like a crystal ball for internet search trends. For instance, Searches for homes for sale early in 2024 are at a laughable index level of 47, nearly the lowest in 5 years, and just about half of what it was during the frenzied pandemic home buying boom in 2021. This is like a canary in the coal mine, signaling what's up ahead in the housing market. If we were expecting a turnaround, we'd see a spike in these searches, but nope, it's the complete opposite. They're in the gutter. So, what's it going to take to get buyer interest back up? Price drops, real ones, not these little nibbles. That's what everyone's holding their breath for. But here's a twist. Home builders have somehow found a sweet spot in this mess. They've been slicing prices and nudging down mortgage rates like there's no tomorrow. And guess what? It's working. New home sales are bouncing back to those dreamy pre-pandemic levels. It's like they've got this secret sauce to lure buyers back. Maybe the rest of the market should take a page out of their playbook. The average sale price for those shiny new houses has taken a nosedive. We're talking a 15% plunge from the dizzying heights of late 2022. Picture this. Prices that once soared to $570,000 are now limping around $490,000. Sure, it's still a pretty penny, but hey, it's a start. And the builders? They're practically throwing mortgage rate buydowns at buyers, dropping them to a tempting 4.99%, while the rest of the market is staggering around 6.5 or 7%. But here's the catch. Builders are just a drop in the ocean of the housing market. They represent a measly 15% of home sales, with their sales figures hovering around $600,000 per year. That's peanuts compared to the whopping $4 million a year from house resales. So while builders are playing the Pied Piper, leading the way with lower prices, they're just a small piece of the puzzle. The real game changer, it's the existing sellers. They need to wake up, smell the coffee, and start slashing those prices more aggressively if we want to see any real shift in buyer demand. But, of course, it's a bit of a mixed bag depending on where you are. Take a stroll through some cities and you'll find sellers slashing prices like they're on a Black Friday spree, getting real about what their houses are worth. But then, there are places where sellers are still floating in cloud cuckoo land, hiking up prices because they think they've got the upper hand. Let's take a peek at RevVenture app's sale inventory deficit data. The blue areas? That's where sellers are playing hardball, clinging to unrealistic prices because inventory is low. Look at Hartford, Connecticut, or Cleveland, Ohio. And don't get me started on Chicago, where inventory is a staggering 42% below the norm. With numbers like that, sellers are holding on to their prices like a dog with a bone. But wait, let's move on down to Texas. Things are a bit different there. In Dallas-Fort Worth, inventory is up 15% above average, and Austin, a whopping 30%. It's in these spots where sellers are getting desperate, slashing prices to lure in buyers. Like this one house south of Dallas, a new build, 4 bedrooms, 3 baths, and a modest 1,000 square feet. Priced at $360,000. The seller chopped off about $30,000, around 8%. That puts your monthly payment at roughly $2,500 or $30,000 a year. But guess what? It's still sitting there, collecting dust on the market for 124 days. The seller's even dangling the carrot of 100% financing in the listing description. Makes you wonder, doesn't it? What's the catch with that 100% financing? Are they that desperate to offload it? The housing market's a wild ride, and it seems like everyone's just trying to hold on for dear life. You see, there's a bit of a sneaky situation unfolding with this property that's been lounging on the market. The current owner, probably thinking they were quite the savvy investor, snagged it back in August 2022 for a cool $339,000. But here's the kicker. They tried to play a quick game, flipping it to make a fast buck. Yet here we are, watching them awkwardly dance the price cut tango, still desperately clinging to a tag that's higher than their buy-in. It's almost comical, right? In today's market, any shrewd buyer would see through this and demand a price that's not just lower, but significantly so, especially with mortgage rates doing their dizzying upward spiral. Now, let's take a detour to the Sunshine State, Florida. For ages, I've been like a broken record, predicting a dip in their market. Well, guess what? It looks like my crystal ball wasn't so cloudy after all. Here in 2024, something's definitely brewing in Florida. Take this. Inventory levels have been going through the roof, especially in places like Southwest Florida. You won't believe the numbers. It's like someone hit the fast forward button. Let's zero in on Northport, Cape Coral, and Naples. The inventory growth there, a staggering 50 to 100%. Homes for sale have almost doubled. It's like watching a hockey stick graph in real time. Remember Cape Coral, Fort Myers? They had a mere 1,000 homes up for grabs 2 years back. Now, a whopping 8,500 homes are waiting for buyers. And it's the same story in Northport, Sarasota, and Tampa, St. Pete. These places have seen their for sale homes skyrocket from 1,400 to 6,700 and 4,000 to over 12,000 respectively. These skyrocketing inventory figures are clear as day. Sellers in Florida are inching towards desperation, soon to be forced into price slashes thanks to this glaring oversupply. Many of these Florida spots are absurdly overvalued. Take Tampa, for example, with a home price overvaluation rate of a dizzying 33%. We're talking numbers that make the '06 bubble look like child's play. Some of you might be scratching your heads, wondering how the heck we figure out if a house is overpriced. Let's take Tampa as our guinea pig. Historically, the average house in Tampa sold for about 3.9 times the median income. Fast forward to now, and houses are trading for 5 times the median income. If that's not a red flag for a housing bubble, I don't know what is. This party can't last forever. The home value to income ratio is going to take a nosedive in Tampa, and frankly, it's the same story in many other American cities. The big question is, will home prices drop, incomes rise, or a bit of both? We need one of these, if not both, to bring back some sense of affordability and allow more people to actually qualify for mortgages. Speaking of qualifying, let's talk about the current state of affairs. The debt-to-income ratio for home buyers is hovering around a nerve-wracking 40%. Yep, you heard that right. For the average Joe buying a house today, 40% of their income is going straight to mortgage and debt payments. That's even more bonkers than during the peak of the last bubble in the mid-2000s. Sustainable? I think not. We desperately need to see those debt-to-income ratios shrink. What about all those homeowners who snagged low mortgage rates in the past couple of years? This has been a huge trend with a large chunk of buyers locking in rates before they shot up. Redfin's data shows that 89% of mortgage holders have rates below 6%, a slight improvement from the 93% back in 2022. Look at this chart. Green for rates below 3%, blue for 3 to 4%, darker green for 4 to 5%, light orange for 5 to 6%, and dark orange for above 6%. More than half of mortgage holders are sitting pretty with rates under 4%. What does this mean? It's freezing the market in a way. The only sellers we're seeing are those forced to move due to life events like divorces, new jobs, or family deaths. This lock-in effect is causing a drought in new listings and inventory, frustrating home buyers who are itching for more options. Los Angeles County's housing market as of November 2023. It's surprisingly balanced, a rare moment of calm in the usually turbulent real estate waters. The median home price shot up to $995,000 in November 2023, a hefty 13.7% increase from last year. Clearly, people are eager to buy in this lively market. As for the median sold price, it's around $872,800, giving home buyers a realistic idea of what they need to spend. On average, houses in LA sell for what they're listed for. It's a sign of a market that's got its act together, for now at least. Homes stick around for about 49 days before selling. It's a decent pace, not too fast, not too slow. Down in San Diego County, the market's buzzing with 4,479 homes for sale and 1,875 new listings as of late November 2023. San Diego's got this neat balance too, with homes selling for their list prices on average. The median sale price there is $858,667, painting a clear picture of the local market value. Nearly half the homes in San Diego sell above list price, showing it's a competitive scene. But still, over a third sell for less, so there's room to haggle. Inventory in San Diego rose to 2,929 homes in November 2023, suggesting more choices for buyers. Homes are selling fast in San Diego, usually in just 13 days, indicating a market that doesn't sleep. The median price for a family home in San Diego was $911,500 in December 2023, down from November but up from the previous year. Statewide, the housing market's had its biggest slump since 2007, affecting both inventory and demand. Experts think things will look up in 2024, with home sales bouncing back and prices moderately rising thanks to lower mortgage rates. In San Diego, demand for homes stayed strong thanks to low interest rates and government help. But there's a snag. The pandemic slowed down home construction, tightening the inventory. House prices in San Diego are climbing, reaching beyond the fancy neighborhoods to the suburbs. The rental market is also likely to get pricier because there aren't enough homes to go around and prices are going up. In Los Angeles, some homes, like one in Venice that sold for $1.9 million, went for less than the asking price, giving buyers a bit of an edge in certain areas. But then some homes, like one in Los Angeles that sold for $1.4 million, 2% over its list price, show how unpredictable the market can be. The San Diego market is also a mixed bag. Some homes sell quickly, others take their time, and prices vary. Even LA's rental market varies. Some places like Santa Monica and Beverly Hills have pricey one-bedroom apartments, while others are more affordable. The median rent for a one-bedroom in California is $2,052, a good benchmark for comparing rent prices across the LA area. Los Angeles offers a wide range of housing options, from budget-friendly to luxury, catering to different needs. Both Los Angeles and San Diego are swayed by bigger economic factors like interest rates and the overall economy. These housing markets keep changing, offering both challenges and opportunities to buyers, sellers, and investors. But what do you think is next for the housing market? Share your thoughts, and if you found this insight helpful, don't forget to hit like and subscribe for more.